All right, today we're jumping into what has to be one of the most dramatic turnaround stories on the stock market right now, a Florida insurer called HCI Group. From an investor's point of view, this thing is a fascinating puzzle of huge risk and potentially massive reward, all playing out against a backdrop of, you guessed it, hurricanes, and some really big legal changes. So to really get a handle on this story, you have to rewind the clock to 2022. The Florida insurance market was an absolute disaster zone, and HCI Group was right in the middle of it, deep in the red. They posted a staggering net loss of over $54 million. I mean, things looked really, really bleak. And then, boom, fast forward to 2024. The company didn't just crawl back to break even, it absolutely roared back, posting a record net income of over $127 million. If you do the math, that is a nearly $182 million swing in just 2 years. Just incredible. And that, of course, brings us to the big question for any investor looking at HCI stock today. What on earth caused this incredible reversal? And probably more importantly, is this profit party sustainable? Or is it just the calm before the next big storm rolls in? So here's our game plan. We're going to start with the bull case. Why the skies suddenly cleared up for these insurers. Then we'll hit the bear case, looking at the hurricane of risks still out there. After that, we'll dig into what might be HCI's secret weapons, and we'll wrap it all up with the final valuation question every investor has to ask. Okay, let's dive right in, starting with the very powerful arguments for being bullish on HCI. And, the story really doesn't begin with the company itself, but with the entire market it operates in. See, before 2023, the Florida insurance market was just a complete mess. And it wasn't just storms causing the problems. It was a legal environment that basically created a storm of lawsuits. This claims cottage industry drove multiple insurers straight into bankruptcy and made it pretty much impossible for anyone to turn a profit for nearly a decade. So in response, the Florida legislature came in and passed a series of massive reforms that just completely changed the game. First, they got rid of one-way attorney fees, which was the main fuel for all these lawsuits. Then, they banned something called assignment of benefits, which stopped contractors from taking over claims and suing insurers directly. They also tightened up the deadlines for filing claims. Look, this wasn't just tinkering around the edges. This was a fundamental overhaul of the whole system. And the financial impact? Well, it was immediate and it was dramatic. Just look at this chart of the company's combined ratio. Now, that's a key metric where anything over 100% means you're losing money on your insurance policies. Before the reforms, in 2022, HCI was losing money hand over fist at 122.5%. After the reforms, it flipped to a very, very profitable 83.1%. That single chart tells you pretty much the entire turnaround story. So, how did HCI take advantage of this new world? Well, their main growth engine has been grabbing policies from Citizens, which is the state-run insurer of last resort. They use their own in-house tech to analyze and basically cherry-pick the most profitable policies, which allows them to grow really fast without a lot of cost. They've already brought on thousands of these policies, and they're approved to grab a whole lot more. But, and you knew there was a but, this newfound profitability comes with a whole storm cloud of risks. So let's flip the coin and look at the bear case. What could possibly derail this incredible success story? This right here is the political powder keg. There are two very different sides to this story. On one hand, you have insurers like HCI posting record profits. On the other hand, Florida homeowners have been slammed with a 34% surge in their average premiums. That massive disconnect creates a politically explosive situation that could easily bring regulators back to the table to unwind some of these very profitable reforms. You know what happens when there's a gold rush, right? Everyone shows up with a shovel. And this insurance gold rush in Florida hasn't exactly gone unnoticed. The number of new competitors that have flooded into the state since the reforms? 15. That's a ton of new capital all chasing the same profits, which will inevitably put pressure on prices and margins down the road. And then you have the risks that are just baked into this business model. First, the obvious one, catastrophe risk. HCI's business is almost entirely in Florida. One massive hurricane could literally wipe out years of profit in a matter of days. Second, reinsurance risk. HCI has to buy its own insurance to protect itself, and that comes from a really volatile global market. And third, they're rated by an agency called Demotech, not the big one, AM Best, That's fine for now, but in a major crisis, it could create a quality gap as people flee to nationally recognized names. So, with the big picture bull and bear case laid out, the real question becomes, what makes HCI different? Do they have any secret weapons, any kind of durable advantage that can protect them from all these risks? First, let's take a quick look under the hood at their structure. You can see it's mostly their two insurance arms, the traditional homeowner's choice and their more techie one, TipTap. But see that little 4% slice labeled Other? That's where things start to get interesting. That other bucket includes Exio, which is HCI's in-house technology division. These are the folks who build all the proprietary software the company uses for underwriting and claims. Management argues this tag gives them a huge edge in being more efficient and better at picking risks. And there's a potential kicker here for investors. They've talked about spinning Exio off as its own public company, which could unlock a ton of value. The second and maybe biggest advantage is the people running the show. There is some serious skin in the game here. The company's chairman and CEO, Paresh Patel, has flat out said, quote, "I have a stated policy of never having sold any of my shares." Now that is a powerful, powerful commitment to long-term value. And it's not just the CEO. In total, the entire group of executives and directors owns almost 22% of the company. As an investor, that is exactly what you want to see. It means management's financial interests are perfectly aligned with your own. Their money is right there alongside yours. Okay, so we've got a very profitable company with a smart strategy and owners who are all in. But what's it worth? Let's talk valuation. Because a great business can be a terrible investment if you end up overpaying for it. The whole valuation story here really boils down to something called the Florida discount. HCI trades at a forward PE ratio of about 6, which is right in line with its other Florida-based peers. But now compare that to Kinsale Capital, a specialty insurer that isn't tied to Florida. It trades at over 22 times forward earnings. That huge gap is the market pricing in all of that hurricane and political risk we just talked about. But here's the thing. Despite that valuation discount, the company is creating value for its shareholders at a blistering pace. Book value per share, a really critical metric for an insurer, grew by over 34% in just the first half of 2024 alone. That recent surge in profit is going straight to the balance sheet, making the company intrinsically more valuable every single quarter. So in the end, it all comes down to this. We've seen the bull case, which is all about these historic reforms, and we've seen the bear case, which is rooted in competition and, of course, hurricanes. The final question you have to answer as an investor is this. Is HCI's combination of proprietary tech and deeply invested management a strong enough fortress to protect these profits from new rivals and the inevitable next big storm?